They say the American dream was built on hard work, innovation, and freedom. But behind the scenes, another engine has quietly powered the nation, one fueled not by gold or trade but by promises. Not the kind you whisper to a friend, but the kind written on paper, backed by faith and multiplied by belief. This is the untold story of how the United States learned to turn debt into strength, how it built an empire out of IOUs, and convinced the world to invest in its own illusion. Let's start with a simple question. When the US government spends more than it earns, where does the rest come from? There's no vault overflowing with savings, no treasure chest beneath Washington. The answer lies in something both brilliant and dangerous: bonds. Treasury bonds, bills, and notes, each one a promise that says, lend us your money now and we'll pay you back later with interest. Investors line up, believing these are the safest assets on earth. But here's the twist: the biggest buyer of US debt isn't China, Japan, or any foreign nation. It's the United States itself. Through its central bank, the Federal Reserve, the US has built a self-financing machine, one that borrows, spends, and then buys its own debt, all within the same system. To understand how this loop began, we need to rewind to 1913, the birth year of the Federal Reserve, right before the fires of World War I. Before that moment, money was chained to gold. You could exchange $1 for a fixed amount of it, a system that kept the government's printing press under control. But war has a way of rewriting rules. The US needed to build armies, forge weapons, and lend to allies. Gold was finite. Ambition wasn't. So the government began issuing bonds and the Federal Reserve stepped in to buy them. The Fed created dollars to pay for those bonds, and the government spent those dollars to fight. When the war ended, the guns fell silent, but the habit stayed. From then on, the bond market became America's quiet weapon, a way to raise money without raising taxes, a magic trick that turned promises into prosperity. Here's how that trick works. The Treasury issues bonds. Banks, pension funds, and investors buy them. Those bonds then become the backbone of the financial system, collateral for loans, assets for banks, and a signal of stability. Then, the Federal Reserve enters the picture, buying those bonds from investors and paying with newly created dollars. That money flows back into the economy, boosting credit and liquidity. On paper, everything looks calm. But in reality, the government has just borrowed from itself. The left hand writes the IOU, and the right hand accepts it as payment. This loop didn't always spin at full speed. In the 1940s, World War II pushed US debt to unimaginable levels. The Fed kept interest rates low to make borrowing cheap. After the war, inflation surged, so the Treasury and the Fed made a deal. The Fed would act independently but always step in when the system shook. That agreement became the backbone of modern monetary control. Then came 1971. President Nixon cut the final tie between the dollar and gold. From that moment, the dollar was backed by nothing but faith and the power to print. The bond market exploded. No longer promises to pay in gold, bonds became promises to pay in more dollars, which the government could create infinitely. Debt lost its ceiling. The Fed gained the power of a god. Throughout the 1980s and 1990s, this system evolved into the invisible architecture of the global economy. Banks, nations, corporations, all built their stability on US treasuries. Why? Because they trusted America to always pay its debts. That trust became the fuel for more debt. By 2008, US debt had soared past $10 trillion. Then the financial crisis hit. The housing market collapsed. Banks froze. The economy flatlined. The Fed unleashed a new weapon, quantitative easing or QE. Imagine the old bond trick on steroids. The Fed started buying government debt, trillions of dollars worth, with money it simply created. No taxes, no exports, no productivity, just keystrokes. This made bond prices rise and interest rates fall, making borrowing cheaper for everyone. It saved the system. Temporarily. But it also set a new addiction in motion. An economy that could only survive on ever-growing debt. Every time growth slowed, new bonds were printed. Every time markets panicked, the Fed stepped in to buy. The cycle never ended. Today, the numbers defy imagination. The United States owes over $34 trillion, and the interest alone ranks among the largest government expenses. Yet, every auction still finds eager buyers. Because the system now feeds on itself, the Fed buys when no one else does, keeps rates near zero in crises, and reassures investors that treasuries are risk-free. Confidence itself has become the currency. But stop and think, why would any nation buy its own debt? Sounds absurd. And in a way it is. But the illusion works because of how people see it. To the public, bonds are savings. To the Fed, they're tools of control. By creating demand for bonds, the Fed manipulates interest rates. Low rates make debt cheaper, cheap debt fuels spending, and spending drives growth, at least on the surface. It's the financial equivalent of pulling yourself up by your own shoelaces. This self-sustaining loop gives the US a unique global advantage. Foreign nations trust the dollar as the ultimate safe haven. When they park their reserves in US bonds, it strengthens the dollar, and that money eventually circles back to Washington. That's why the US can run deficits year after year without losing faith. The dollar isn't just America's currency, it's the world's. But every trick comes with a cost. By buying its own debt, the Fed's balance sheet has exploded, from under $1 trillion in 2007 to over $8 trillion today, filled mostly with US bonds. When rates rise, bond values fall, and those paper losses grow. Meanwhile, the Treasury must borrow even more to pay the interest, a spiral that only stays upright because people believe it will. If that belief ever falters, the illusion collapses. That's why every word from a Fed chair moves markets. A hint of tightening and yields shoot up. A promise of easing and they fall. Confidence is the only thing holding the trick together. Break it and the system cracks. We've already seen glimpses. In 2013, when the Fed hinted at cutting back on QE, markets panicked. Yields surged, stocks stumbled, and the Fed backed down. In 2020, the pandemic hit, and the old playbook returned. Trillions more were printed, flooding markets with liquidity. Each rescue made the illusion harder to unwind. Once an economy learns to depend on self-financed debt, withdrawal becomes lethal. The question now is simple but terrifying. How long can this go on? Can a nation keep buying its own promises forever, or does every trick, no matter how clever, eventually run out of magic? Because beneath the polished numbers and calm speeches lies the real story, a transfer machine. Each time the Fed buys bonds, wealth quietly moves upward. Big investors, banks, corporations, hedge funds, get the new money first. They buy assets, stocks, and real estate before prices climb. Ordinary people only feel the effect later, when costs rise but wages don't. Debt doesn't just fund the government, it redistributes wealth. It creates an unspoken alliance between Wall Street and Washington. The Treasury borrows. Banks broker the deals. The Fed buys from those same banks, injecting liquidity that fuels asset markets. Everyone wins except the public, who pay through inflation. The more debt circulates, the more the system depends on it. Shrink it and the economy seizes. Expand it and inflation bites. There is no easy exit. Look at every major crisis, 2008, 2020, the response was always the same. Print, borrow, buy. Each round saved markets but widened the divide. By 2021, American billionaires had gained over $2 trillion in net worth. Meanwhile, workers faced rising rent, healthcare, and food costs. The trick kept the system alive, but it tilted the entire board. Debt has even changed politics. In a world where borrowing looks painless, fiscal discipline disappears. Why raise taxes or cut programs when you can just issue more bonds? Highways, wars, subsidies, all build to the future. The true cost hides behind the Fed's balance sheet. As that balance swells, the new money filters through banks and investors before reaching the real economy. That delay favors capital over labor. Asset owners win first, workers later lose through inflation. Over time, this compounds inequality. The top 10% own nearly all financial assets, so they profit from the game. The rest hold cash, which quietly erodes. This isn't coincidence. It's design. In 1980, US debt was under $1 trillion. By 2000, it was $5 trillion. After 2008, it doubled again. Every crisis brought the same cure: more debt. Politicians promised growth would outpace borrowing. It never did. Debt to GDP kept climbing. Today, the US owes more than its entire annual output. So why hasn't it collapsed? Because America's debt is written in the world's reserve currency. It can never run out of dollars, it can always print more. But that safety breeds complacency. If foreign confidence ever fades, investors demand higher yields. Higher yields mean higher costs. And higher costs mean more debt. It's a treadmill with no off switch. China and Japan once held over $1 trillion each in treasuries. Both are cutting back. Domestic institutions and the Fed are filling the gap. Whenever the Fed retreats, markets stumble. Whenever it returns, markets rally. The entire global economy now reacts to Fed bond purchases like a patient dependent on medication. Skip a dose and the symptoms return. This is the world built on the bond illusion, a masterpiece of financial engineering sustained by faith, repetition, and the belief that tomorrow will always come. But deep down, one question lingers. What happens when the illusion finally breaks? When yields rise, the world shakes. Mortgage rates climb, housing cools, and stocks stumble. Then the Federal Reserve steps in, buying bonds, pulling yields down, reviving credit, and restoring speculation. The cycle resets. Prices stabilize, but reality drifts further away. A $300,000 home becomes $600,000, not because it's twice as valuable, but because easy money inflated everything around it. When borrowing feels free, everything else looks expensive. This is the hidden cost of a credit-fed world. Banks assume bailouts will come. Corporations expect lifelines. Governments count on the Fed to clean up every excess. Each rescue strengthens the illusion, until economic health is judged not by innovation or productivity, but by how much debt the system can swallow. Critics call it managed finance, capitalism on autopilot. Market signals no longer speak truth. Interest rates, bond yields, risk premiums, all mirror central bank policy. The Fed sets the rhythm and the markets dance to its beat. When yields are artificially low, weak firms survive on cheap credit. Zombie companies wander through balance sheets, draining capital that could have built new industries. And the distortion doesn't stop at America's borders. It ripples across the planet. Emerging markets peg their currencies to the dollar or hold treasuries as insurance. When the Fed prints, global liquidity surges in. When it tightens, that same money rushes out. Latin America learned this in the 1980s, when rising US rates crushed economies from Mexico to Brazil. In 2013, even a whisper of tapering sent investors fleeing from Turkey, India, and Indonesia. Every shift in US policy shakes markets worldwide, because every nation is tied to the dollar. When the anchor moves, all ships sway. Inside the United States, this dependence turns central banking into politics. The Fed is supposed to be neutral, but its decisions swing elections. High rates slow hiring and crush housing. Low rates pump up Wall Street. Every president wants easy money before an election. Every investor tries to guess the Fed's next move. Policy becomes theater. Meanwhile, the public debate stays shallow. News outlets talk about raising the debt ceiling as if it's a budgeting problem. But it's not. It's a ritual. Congress spends first, argues later, and always raises the limit, because default would destroy global confidence. And so the cycle repeats, larger each time. Some economists defend the system. They say liquidity is oxygen for modern economies. Others warn it's unsustainable. The truth sits uneasily between. The bond trick keeps the system breathing but weakens its bones. Debt can't grow faster than income forever. Eventually, interest outruns revenue and the trick becomes a trap. We're nearing that point. Interest payments now exceed $1 trillion a year, more than America spends on defense. Cut spending and recession hits. Raise taxes and growth falters. So the path of least resistance wins, more bonds, more printing, more illusion. The longer it runs, the harder it stops. The bond trick didn't just finance America, it built a global empire. Every nation that trades in dollars, saves in treasuries, or prices oil in greenbacks sustains that empire. The US doesn't need colonies, it has the bond market. Here's how it works. Foreign nations sell goods to the US and earn dollars. They invest those dollars in treasuries for safety. The treasury uses that money to fund its deficits. The dollars flow out for imports, then return as debt purchases. The world exports goods, the US exports promises. As long as everyone trusts the paper, the system hums. Trust is the real currency. But cracks are forming. China promotes the yuan in trade. Russia and parts of Asia are shifting toward gold and regional currencies. The BRICS nations talk of a shared reserve asset. None of them have dethroned the dollar yet, but the intent is clear, they want out of the loop. Why? Because US monetary policy exports instability, When the Fed prints, inflation rises globally. When it tightens, liquidity vanishes. Other nations pay for decisions made in Washington. For decades, they accepted that cost because treasuries were considered untouchable. But even that faith is fading. Political gridlock over debt ceilings now turns domestic disputes into global shocks. Credit rating downgrades and partisan standoffs worry foreign investors. If confidence cracks, they'll diversify fast. That would push yields up, forcing the Fed to step in again, spinning the loop even faster. There's also the geopolitical side. The US uses the dollar as leverage, freezing assets, cutting access to SWIFT, blocking trade flows. Each use of that power tells the rest of the world, if we control your money, we control your choices. So nations are quietly preparing escape routes, stockpiling gold, developing alternative payment systems, and experimenting with regional currencies. They're not defying America's wealth, they're hedging against its control. At home, the bond trick reshapes expectations. Debt no longer signals danger, it feels normal. Every crisis brings more borrowing, every rescue adds trillions. Politicians promise endlessly, knowing the Fed will cushion the fall. Fiscal restraint sounds outdated in an era where printing money solves everything. Inflation has become the only visible limit, and even that fades from memory once markets recover. Yet inflation is the silent tax of modern finance. When the Fed buys bonds with new money, prices rise quietly while wages lag behind. Savings lose value. The government repays old debt in cheaper dollars. It's a soft default that hides in plain sight. Those who understand the game protect their wealth with real assets, property, stocks, commodities. Those who don't, lose purchasing power without realizing it. Every cycle of cheap money inflates confidence, until rates rise again. Then bonds fall, banks take losses, and the illusion wobbles. In 2023, several U.S. regional banks collapsed because their safe treasury holdings tanked as yields spiked. The safest asset turned toxic. The risk didn't vanish, it's waiting for the next turn. Some call this financial repression, governments keeping rates below inflation to manage debt. Savers lose, debtors gain, and wealth quietly shifts upward. It worked after World War II when growth was strong. Today, with aging populations and weaker productivity, it's a gamble. Low rates feed speculation, not innovation. Debt piles up faster than the economy can support it. And at the core of it all lies one fragile word: belief. As long as the world believes US debt is safe, yields stay low and the illusion holds. But if that trust fades, yields surge, borrowing costs explode, and the Fed faces an impossible choice: print to save the market or let it fall. Either choice exposes the truth. That's the paradox of modern finance. Every escape leads back through the same door. Debt delays pain. It buys time. It flatters politicians, comforts voters, and rewards investors. And in return, it borrows the future. So where does that leave you? You live in a world priced by debt, every mortgage rate, paycheck, and stock value tied to treasury yields. Understanding this isn't theory, it's survival. Because no empire, no matter how powerful, can borrow forever. Rome clipped its coins. Britain debased its pound. Each believed its money would last forever. The United States believes the same. But every illusion lasts only as long as people believe it. Confidence grows slowly and collapses fast. The lesson isn't panic, it's awareness. The bond trick built the modern world, and one day it might unmake it.